All right, so I want to talk about what is venture. I want to talk about what is venture capital. I think that this is a really important thing, and I'm probably going to get a lot of things wrong, probably going to get a lot of things right with this, but take it with a grain of salt in terms of venture capital. So I am I'm going to get into this, right? So I'm Professor Dave Masek. I'm an associate professor of innovation strategy and entrepreneurship. And I created this whole reciprocity project to give back as much as I possibly can. There's so many people that help me out that I want to pay the favor for to help you out as much as I possibly can. So sorry, I stumbled because I kind of goofed that. Anyways, venture capital. You know, what exactly is it? You hear about this all the time. So the first thing to know, it's not free money, and in fact, it's probably the worst way to possibly think about it. You have a lot of sort of requirements to do the right thing. So basically, you can think of venture capital as a way to pool resources from people that are interested in growing companies. And they just pool it together, and generally, so we do this in your parents, other people around you do this all the time in terms of pooling money into the public stock markets. And we do this on a regular basis. I have mutual funds. That's what I'm doing. I'm pooling money into the public stock market. In fact, when you pay taxes, it's very similar because you're pooling it into this sort of bigger, larger entity, and then somebody else is sort of managing that and finding growth opportunities in, whether it's the American, Canadian, British, whatever, Australian, Indian market or, country. That's what we're doing, right? We're pooling it and somebody is sort of determining where the growth is going to be better by pooling that money, and they are giving some allocating resources to that. And that's essentially what venture capital is. People get this pool of money together, they get a fund together, and it's usually really wealthy people. Not always, but pretty wealthy people that are going to be sticking some money into this pool of money, sort of aggregate amount, and then some fund managers, venture fund managers, whatever they might look like, they're going to go around and pick different different companies that they think are going to be somewhat reasonable in terms of growth, and they're looking for, generally venture capital is a weird one. Because what they're looking for, most venture capital firms are looking for, groundbreaking things. So they're looking for things that are going to be really big. So they're looking for things that most things, and this is what you're going to expect. Most things are going to be duds, and they know this. So they're going to pool money and give, some companies that they expect to do really well. They expect to do really well, but they end up being duds. And you just don't know which one is going to be which. And so vast majority of them are going to be duds, and they're expecting that one of those, and they might put in, 20 different companies, put some money in 20 different companies. They expect one of those 20 to just be rock stars. And then from that's going to drive the performance of that fund. And so if they can get 2 or 3 that are rock stars, that are doing really well, like good returns, making lots of money, all that kind of stuff, then that's amazing. But generally it doesn't happen as much. And they kind of they do a tremendous amount of vetting at the beginning. So like making sure that everything is legit, and really working hard to making sure that they're placing good bets. It was super hard to place good bets in anything. Like this is really an art. It's not a science. And so when they do that, when they give you some money, I don't know, whatever it is, maybe they give you $100,000 or $1 million or something like that. Whatever that amount is, it could be $1. That they're going to have some stipulations behind that are, they're going to be all sorts of requirements for you to, whether it's reporting to them, whether you're meeting certain targets. And then if you don't meet those targets, they're going to pull funding. So you really have to make those things and make those targets, make sure it's all going to be really well aligned to what their expectations are, because they're going to pull funding. And then if they do that, let's say you've got the venture capital funding, it helps you grow to a certain point, and if you don't reach, I don't know, maybe they're expecting 20% growth every year, and if you don't maintain that, or if you don't get that, then they're going to pull that funding. And so if you're getting 10% growth, you can easily, implode on yourself because you're going to run out of resources after a while because you're betting on that. And so you have to cut back, what you're doing, the growth and all that kind of stuff. So think of venture capital funding is really just putting gas on the fire. So you're already doing really well. And if you're doing spectacularly well and things are exploding, venture capital funding could be really good and be very helpful. But if you're not and you're looking for, just kind of like free money, man, it's going to suck for you and it's probably going to destroy that opportunity in general. And you probably shouldn't do that unless you know what you're doing. It's really, you got to know what you're doing to really do a good job with venture capital funding or just like getting money in general. It's bloody hard to manage a lot of money. I know it seems really crazy if I'm saying this. You're probably like, no, how can that be? I mean, think about this, right? Like if you can't manage $1,000 of your own money, how are you going to be expected to manage like 10 million bucks? Somebody's giving you 10 million bucks. If you're not good at it, it's gonna really stink, and that's what they're looking at, right? Like, are you doing the right things? Is this kind of like gravitating in the right direction? And so, what they're looking for, venture capitalists are really looking for, ways to fund different areas that they wouldn't normally fund, and that are hard to fund without that. And the reason why they have managers and stuff like that, it's because these wealthy individuals, generally pretty wealthy individuals, they don't want to be going and looking for people. So they hire people to go look for these opportunities. And so, what I recommend venture capital funding. If you're interested in this, it's a mixed bag. I would definitely sort of really think twice and be very cautious. Any outside funding, be very cautious and take your time with it. It's probably not a great idea unless you're really ready for it. And it's just like, again, it's like gas on a fire. If you put gas on a fire and you're not ready for it, it can blow up in your face and everything's going to be terrible. But if you're ready for it and you're doing it right, you could really get going with it, and things could go very well. So just really take your time and really think about whether you need it at this moment. If you don't need it, then slow it down, take your time. You think good things will happen if you do that. If you take your time as well, it's just not going to take as long. And so you're just really adding a lot more risk to it. And you just really got to take some, if you're a portfolio company, that's what the companies they invest in, that's what they're called. Just take your time. And if you're a venture capitalist, don't hate me for telling this advice. But I'm pretty sure you know what I'm talking about. All right. Take care and have a wonderful day. Bye-bye.